Joining me now is Bob Parker, Senior Advisor at Credit Suisse Asset Management. Bob, great to have you in the studio. Now, we talk about gold being an asset bubble, we talk then about it being a safe haven. How far can it go? Are we in an asset bubble, or is it going to reach 2000, if not beyond?
Well, first of all, what do we mean by a safe haven? And the answer is investors are very long the gold market, and they're long the gold market because, first of all, they have distrust in the major currencies, the dollar, the euro, the yen. They also have distrust increasingly in sovereign bond markets. So therefore gold is being purchased in investor portfolios almost as an insurance policy. Now you have to ask, what is going to turn the gold price around? And you know what?
Fed policy.
Well, you will only get a turnaround, I think, in the gold price if you have, let's say, the Fed raising interest rates. That's not going to happen for at least a year. If you have renewed confidence in the US economy and solving the Eurozone crisis, I don't see that happening immediately. So those catalysts which have been driving the gold price higher, I don't see any reversal.
Yeah, so they'll continue. Bob, I wanted to ask you about the situation here in the UK, because 10-year yields were at a record low today, and we've heard a lot of politicians saying they now see the UK as a safe haven. This is a double-edged sword. I mean, surely we don't want to be here in the UK a safe haven, because it means that it will put extra pressure on the currency, and the recovery is not that hot.
Well, you say put extra pressure on the currency. One theme of foreign exchange markets for over a year and a half, of course, has been the trade-weighted weakness in sterling. And given the UK macro environment, I don't see any change there. There are a number of special factors in the gilt market, of course, so that when Basel III and the solvency rules come in to apply to insurance companies, that's going to make them a forced buyer of gilts. So we do have one or two special factors driving down gilt yields.
Bob, look at the pound dollar, 162.79, 10-year UK gilt at 2.7. What happens if the US actually loses its AAA credit downgrade, if it gets downgraded? Will the UK, again, will we going to see a lot more buying of pound and also of UK gilts?
I think the answer to that is probably yes. But if one looks at the pound against the dollar and against the euro, we are comparing fundamentally weak currencies with each other. And you have to ask the question, what are going to be the strong currencies? Well, obviously, it's the Swiss franc. Elsewhere in Europe, I would argue the Swedish krona has become a safe haven currency, and the yields there are exceptionally low. I would also argue, and particularly if the US does get a downgrade, which looks increasingly probable, we will see an acceleration of capital flows into the areas of the world which show still reasonably strong growth.
So what, emerging markets,
so
China?
emerging currencies, particularly the Asian currencies, are still very undervalued. So that appreciation of Asian currencies, I think that trend is intact.
Bob, you say that a downgrade of the US economy is likely. Are we talking in the next couple of months, and why is it not priced in the markets yet?
Well, the downgrade process has three stages. First of all, the credit rating agencies put the US under review. That's already happened.
Done. Yeah.
The second stage is to put the US on negative credit watch. That has not happened exactly yet, but I'm assuming that will happen sometime between now and November. I think the risk of a downgrade is if this second phase of the budget public expenditure cuts does not come through in line with expectations in November. November is a danger period for the US budget deficit, and then you might end up with actually a formal downgrade.
So what does it mean actually for equities in general? Or are you advising to just stay away from them until you see a clearer situation, or at least until growth picks up a touch?
Well, I think actually the downside now on equities is very limited. Equities, all the fair valuation models show equities to be very cheap relative to government and corporate bonds. Investor cash positions are very high, corporate cash positions are very high, and obviously valuations are cheap, and I would argue the markets are discounting a significant amount of negative news.
But Bob, I guess this is actually assuming that we're not going to see a double dip recession, which at this moment we can't rule out, can we?
Well, my thesis is we are going to go through a period, and a period could easily be 1 to 2 years, of mediocre growth in the United States, in Japan, There the risk is that the recovery isn't up to investor expectations. Northern Europe, I think growth can be maintained. Asia, Latin America, growth is moderating. The risk of a global double-dip recession is very low, but in the States and certainly Southern Europe, we're going to go through a period of mediocre growth. You could also include the UK in that list.
Okay, despite it being a safe haven for now.
That doesn't stop us going through a period of mediocre growth.
Absolutely right. Bob, thank you. Bob Parker there.